can you invest outside the markets? Welcome to Taxevity, where you get insider insights from people who make life better, our many clients and friends. My name is Pramod Sharma, and our guest today is Vikram Rajagopalan. Welcome, Vikram.
Thank you, Pramod, for having me.
Now, you are the Regional Vice President at Trez Capital. Could you please tell us what you do there?
Yes, Pramod. I mean, sometimes it is difficult to have that 10-second elevator pitch when it comes to Trez, but I think for most people out there, I'm in the business development role, and my main purpose is to go out there and educate portfolio managers and family offices and financial advisors on what Trez does and how it adds value to portfolios today. Our title is Thinking Outside the Markets, and that's what Trez really provides, is a solution for people to invest in mortgages, is predominantly what Trez does, invest in mortgages, but most importantly, give them access to a solution that is not correlated to the markets. And so really, more than, I guess, selling, specifically with something like Trez, I go out there and educate, because most people would have never heard of the asset class or would have never even heard of the company or specifically what we do. So that is my role.
Okay, now when we met years ago, you were developing personalized portfolios for high net worth clients. What has changed?
I've always told people, when you look at someone's resume, hopefully it has a story to tell. And so for me, I started my career at CI Financial, where I was just sort of a wholesaler going around financial advisors for mutual funds. And then I joined private wealth management at the midst of the financial crisis, because specifically with high-end clients, they wanted more customized portfolios. They wanted access to a portfolio manager. I saw that. I saw there was a bit of a shunning among high net worth clients towards mutual funds, and so I wanted to join private wealth management. At the end of 2012, with sort of interest rates the way they were, and I'll just backtrack a little. The old adage in portfolio construction was quite simple. You had stocks and you had bonds, and when stocks went down, bonds did well because people would just flock to bonds, and when bonds did, and vice versa. But today we are in a bit of a conundrum, because one is, if stocks do badly, people are not necessarily going to flock to bonds, because bonds are not paying anything because of such low interest rates. And I've recognized that challenge, specifically at my old firm, but also with our competitors, specifically in the fixed income space. As you know, in the insurance industry that there is an aging demographic. And so fixed income is still a very vital part of people's portfolios, because regardless of how well equity markets do, you can't be overexposed to that if you're 60, 70, or 80 years old. And so it got me thinking about what is outside of that quintessential stock and bond. What is outside of the markets per se. And when you came down to it, I discovered Trez, I discovered the world of real estate and mortgages. But there's also a whole lot of other solutions that I've figured out as well, which, with private equity and infrastructure.
And we'll be talking about some of those today, so that's great.
And that was really the reason I joined Trez, because it added value at the time.
Okay, now when we talk about the markets, what are the markets, first of all?
The markets are like anything. And I'll say we, the people of the finance industry, talk about markets, we talk about the stock and bond markets, which you can trade in and trade out every day. It's what your do-it-yourselfers to the portfolio managers, your TSX, your Dow Jones, your DEX bond universe. This is the markets where every day people are buying and selling stocks and bonds. And why it's so popular? Because there's always daily liquidity. There's always a market for what you're buying. But what has happened over the years, having seen two major downturns in the last 10 years, be it the 2000-2001 downturn and then the last financial crisis, with it comes a lot of volatility. And so that's what we call the markets. The markets are your everyday markets where you trade stocks and bonds.
Okay, and why would people look outside the markets? Is it because of the volatility that you mentioned?
Yes, I mean, I think what people realized is they say as much as diversification was talked about, people really weren't well diversified. And the TSX was doing really well, the Dow Jones was doing really well, the bond markets were doing pretty well, but everyone was exposed to the volatility of the daily markets. And the daily markets are not really your asset that you're holding, a stock or a bond in the daily market, it's not really priced for the value. It's what the public perception is of that asset. And so sometimes you don't have control over how much money you're going to make or how little money you're going to make. And so what people have come to realize is just trying to get out of that daily fluctuation that you see. Now, when things are going up, it's great.
Yes.
And people are wondering, well, why would I look anywhere else? But 2008 has really taught a lot of people that, yes, there are times when it's nice to have things that are not at the beck and call of the public markets. And that is why people are looking outside into what you call the private market.
So what sort of things can they look at outside the normal markets?
Well, the easiest place to go, and people have been talking about this, if you look at the major pension plans, Ontario Teachers and Ontario Public Pension, they have a great pie chart which shows that they have moved a lot out of public markets into things like private equity. Private equity is when you buy companies. Take Dell. Everyone knows Dell. When Dell went privatized, then that's private equity. Onyx being a big firm that did that. You take it private and then you work it out over 4 years and you bring it back. There, your value is always steady. Infrastructure. We've heard about this, the infrastructure age in terms of building out highways and roads, and that is generally on the private side. Real estate and mortgages, the world that I live in, is on the private side. And finally, there's a world of private debt, which yesterday in the Wall Street Journal said that private debt has raised over $173 billion in the last 5 years because of portfolio managers wanting to get out there. Private debt is lending to individual companies who might not have bank financing, and so that's a private debt space. All of the spaces have one quintessential commonality, and that is its income and yield investing. Because at a time when interest rates are so low, and the fact for you to get a decent enough return, you have to take more and more risk in the public markets.
Right.
Then this is what are people going, how do I get the income to sustain my portfolio without putting myself out there to lose my capital because I'm in the public markets? Those are the sort of commonality among these private investments.
Now, private markets sound risky, maybe because we don't know that much about them. What sort of things can go wrong?
Well, in anything private, and really the one knock against the private markets has always been transparency.
Okay.
Right? I mean, transparency hasn't been great in the private markets, by essential it's private.
Yes.
Right? And so the number one risk in the private markets, be it real estate, be it infrastructure, is what we call managerial and operational. Who the manager is very, very important, because there's no other asset class where you create the security and you manage it. So for example, in Trez, we underwrite the mortgages and then we manage them. So we've created the security that we're managing. As opposed to, say, your mutual fund manager that might hold Apple, you have a bit of solace because you know what Apple does, that he's doing the right thing. So managerial and operational longevity is very important, because when things go wrong in the private space, they can go very wrong. Right?
Okay.
So if you're with an operator that overpromises, who is small, who's only been around during the good times, then watch out. There have been bad stories. It's sort of been, in the last few years, there's been a ton of stories of people who've had to shut down, not giving investors money back. The commonality among all of them, they tend to have been small. They have no institutional clients. Their transparency has been weak. Right?
Okay. Are there any other risks?
Well, liquidity.
Liquidity. Okay.
When you go from the public arena to the private arena, it's always going to be about liquidity. The whole attraction of the public arena is, if I don't like something today, I can get rid of it tomorrow. And the private side, that is what you're giving up, is the liquidity, because you have to have patience, you have to see the returns, you have to see the annual returns. But in many cases, you're doing 3 or 4 year projects, specifically in private equity, or if you're doing real estate and you're buying a building, it's a 3-4 year project. So if you have buyer's remorse 3-4 months into it, well, guess what? Maybe you can get out. There are various stipulations, but most likely you have to have a longer term outlook. Having said that, that has been the downfall of the public markets. You should still have a longer term outlook in the public, but because you're given access to the ability to buy and sell anytime you want, you use that, and it's been mostly detrimental to investors.
Where does Trez fit in?
So Trez fits in that alternative space. What Trez does is called short-term bridge financing.
And what is that?
And short-term bridge finance, I love the fact that you asked that question because I can talk to an institution that's done real estate for years, and I can talk to an 80-year-old woman who's been a small business owner, and the 80-year-old woman who's a small business owner would likely know it, and the institution does not. The short-term bridge financing space is a very unique one. Short-term bridge financing is a loan made, a mortgage that is made to commercial, industrial, and multi-residential projects. That's what we specialize in the value add stage of real estate. So it's a building that has been in existence maybe for 5 or 6 or 7 years, is somewhat getting dilapidated. I'm using it as an example.
Right.
That needs refurbishment. And that and needs, and that might be new elevators, new floor, whatever that case might be. And the banks are not interested in lending to something that's short, because that's a short-term mortgage. So and so the borrowers are willing to pay a premium in order not to deal with the bureaucracy of the banks, to be able to have an open mortgage, because all of Trez's mortgages are open, and to enable them to add value to that real estate, so that when they do go back to the bank for longer term financing, in some cases they get a better rate, but they also have a better property now, right? And it sets them up for the longer term. And so we at Trez, we manage about $1.8 billion of these kind of loans in the short term space. But from an investment management perspective, where it adds value is your biggest risk right now is interest rate risk. So being short term is very attractive to a lot of portfolio managers.
And that's because rates may be increasing and you don't want to be locked into low rates.
Exactly. And quite frankly, I'm not a protagonist when it comes to where things are going, and I have no idea. Like as you and I were musing,
I've got no idea either.
I still can't believe I'm paying the rate I'm paying on my mortgage that I signed 3 years ago on a variable rate. I thought it would be at least 1% higher. I still, and yesterday it was said the Bank of Canada has now held steady on rates for 4 years, which is the longest it's ever done since the Depression. But the reality is that is in the back of people's minds. So to be short and not to be locked in to a rate for the next 3 to 4 years is very important. But if you have real estate concerns too, to be short and not to be locked in for 3 or 4 years also matters. And from a liquidity perspective, the attractiveness is once again being short term and generating the interest. The liquidity risk goes down as well. So Trez has been very successful at sort of fitting that niche of fixed income investing. Obviously comes with risks.
Okay,
right?
But when I think of short-term investing, I'm thinking of low returns. What sort of returns does an investor get?
Well, generally in this space, as I said to you, a first mortgage goes in about 7% of prime plus 4.
Okay.
And so, and in some cases, second mortgages are 9 or 10. So a combination of it. For example, we have an all first mortgage fund that does only first mortgages, and the net return to investors is 5 to 5.5%. Our sort of flagship, which is a combination of a third, second mortgages, clients probably get somewhere in the 7% range, right?
Okay.
So really, those are the kind of returns that you're looking at, which is a substantial premium over investments that are giving 1 or 2. Now, granted, that has the G word in it, which is guaranteed. And I want everyone to know on this interview, there's nothing guaranteed about what we do.
Right.
But there's something, if people understand, once again, it comes down to diversification. You're not putting all your eggs in this basket. It's about just taking that piece of your portfolio, moving it over, not just with Trez, but just anything on outside of the markets that adds a little bit of value to your portfolio.
Okay, now are you doing anything risky like subprime lending?
No. I mean, there are 4 main reasons people borrow from us, and I want everyone to understand this. The majority of the people that borrow from us are worth anywhere from $100 to $150 million of net worth.
Oh, really?
They're experienced real estate developers, real estate borrowers. Outside of the fact that maybe the real estate is not the AAA stuff that the banks now want post a financial crisis. We all have been to a bank and we understand the bureaucracy that's involved in getting any loan. So if you think of a firm like Trez that maybe has 30% of its mortgage portfolio in a place like Alberta, which is very fast paced, most of these developers cannot, and most of these people cannot afford to wait around 8 or 9 months for the bank to approve an 8 or 9 month mortgage. It doesn't make a ton of sense. They want to go to a specialized short-term bridge financier like Trez because we know what we're doing in that little niche. right? Instead of
Right.
dealing with one little part of it, or one little part department of the bank. Two is the banks are interested in asset liability matching. So the banks have long-term liabilities. Therefore, they
Okay.
want long-term assets. So they're not interested in doing 13, 14-month mortgages. They want 5, 6, 7-year mortgages,
Okay.
right? And so this space is just, and Trez, by the way, is $1.8 billion of assets. Now, in the quintessential investment management space, that's maybe 16, 17 employees. Trez is 75 employees. It's a very laborious industry. Because
Okay.
if something goes wrong, you got to take it over. You got to do all that. The banks are not interested in adding headcount,
Good
right?
point.
And
Yes.
so and then we're also open mortgages. The banks don't give open mortgages. So because we attract the most successful developers, they're willing to pay a premium for the ability to prepay without penalty because they have confidence in their project. They know they can get out in
Okay.
advance. They don't have to deal with that bank bureaucracy. So that's a reason not only Trez but private lenders like Trez exist. And by the way, there's a lot of people that do what Trez does in the short term. You might not have heard of him. Trez is one of the biggest. In fact, I believe maybe the second or third biggest. And I get back to the managerial and operational. When I go around and I talk to people and they're with someone, when things have gone wrong is because you just don't know what's inside that portfolio because of transparency.
Right.
You're dealing with a very geographically concentrated area. Trez, the great part it's around it. So not just for Trez, but whenever you're looking at something on the private side, make sure it's diversified, the portfolio is diversified. You're not down to regions because, as you know, in Canada, the regions do matter, right? Quebec is
Yes.
different from Alberta, that's different from BC. It's a vast country. The fundamentals are different. So, you get someone who's 90% in Alberta because the markets are hot. You should know that because if it goes down, Quebec's different. It's just getting there. The Maritimes is booming. It's starting to boom. So different things that you have to look
Okay.
at.
Now, do you have an example of short-term bridge financing being used?
Yeah, I mean, one of the biggest loans we did was in a mall in Calgary called Century One Mall, and some people who have been to Calgary would know this mall very well. It's one of the biggest, and Walmart was its biggest tenant, made up about 60% of its revenues, and we've done a couple of these loans with Walmart, and with Walmart, if they so decide to leave, it kills the entire mall, right? And so when Walmart made the complaint that, this is a dilapidated mall and you need to make the fixtures, the bank that had the first mortgage was very concerned because obviously if you lose the 60%, they don't want to be stuck in a 5-year mortgage when when your biggest tenant is leaving.
Right.
So they approached Trez and said, look, can you take over the first mortgage? We need to do these refurbishments and everything else. Trez talked to each individual vendor in the mall, found out Walmart would stay if in case this is happening. And so we lent them the money in order to get all of that done, more parking lots put in, this, that, the other. And then at the end of the day, Walmart, after it was all done, Walmart decided to stay. Then the bank at the time came by and took over the long-term finance.
Okay, that sounds like a terrific win.
Yeah, it is. I mean, the other one is the Chrysler Building in Windsor. That's another great example of why someone would come to us. A German consortium came in during the financial crisis. At that point in the financial crisis, what's your commitment to the Chrysler Building in Canada, right? I mean, you have to figure out, do you want 5-year financing at a time when you don't know what's going to happen? So they want to keep the building alive. They just want short-term financing. And so they borrowed like $26 million from us and paid us a rate of 7.5% on that loan from a reputable firm like Chrysler. Now, at that time, we made the bet that Chrysler was a very good, Chrysler was a good company. We knew it was going to come out. They said at the end of it, either they were going to sell the building and pay us off or they were going to get longer term financing. They chose the latter, right?
Okay. Now, with rewards, there are also risks.
Yeah.
What sort of things can go wrong?
Well, if you're talking specifically for us, I always say when things go wrong in our business, they go really wrong, right? I mean,
I don't want to hear that.
Yeah, I mean, I think I always like to talk about the risk removal because the way the fund is structured and the investment is structured in someone's portfolio, it stays at $10 and spits out a target 7% annual distribution. So off the bat, it looks and sounds like a money market, and it isn't. And the biggest risk Trez has is a bunch of people coming in thinking it's a money market, and then we get short-term investors, right?
Okay. So they want their money out in a very short period of time.
Yeah, exactly, because they think, okay, I'm making 7. No, that should never be the case. This is not slated for short-term money.
Mm-hmm.
And really, our founder will always say this. People like it's Trez takes risks. It's about managing those risks.
Yes, okay.
When you're making 7% in this interest rate environment, you're always taking risks because these are value add stage. These are not no-brainer deals, lack of a better term. If they were no-brainer, the banks would do them. Mm-hmm. So the reality is that there are risks associated with the deal. So the biggest risk is, what if your borrower can't pay?
Mm-hmm.
That's why it's important to know that Trez has a team that actually goes in and takes over things in case something goes wrong. And we have. In 2008, we did that. During the financial crisis, we actually went in and took over some deals. That's why it's important to know that we have 75 employees.
Okay.
Right? As opposed to someone else who says, by the way, we manage the same amount of Trez, we only have 20 employees. That's because when times are good, no one thinks they have to take over anything.
Okay.
So when I talk to investors who, by the way, go directly into a building, I say, I've been in real estate for years, I can make the same returns you have. Mm-hmm. I would say, have you ever foreclosed on someone?
Okay.
And if the answer is no, then you really are not in real estate until you've actually foreclosed on someone.
Okay.
Right? Because that's when the rubber hits the road. What do you do when things go wrong? And Trez, why we've got, and some other places, why we've got the sort of confidence of the highest end institutions in this country, mm-hmm. is because we know how to value an asset and we know how to get out of an asset.
Okay.
Right? We don't lend to anything we wouldn't own in case of something going wrong. But at the end of the day, we don't lend to own.
Okay. Right? Now, so are there other risks that we should be aware of?
At the end of the day, the biggest risk with us specifically is always going to be reinvestment. So people in the bond market will understand this, right? Reinvestment risk is when you're short term. Mm-hmm. Okay. So in real estate, managerial and operational, liquidity, real estate, and reinvestment are your 4 risks. Mm-hmm. The first 3 are negated at Trez, not negated complete, but managerial and operational, as I said, we've been around longer than anyone else since 97. We have the highest end institutions and all of those good things. Mm-hmm. Liquidity is negated because it's short term. Real estate values is somewhat negated because it's short term. Okay. The highest risk is reinvestment.
And that means that, say, the loan gets repaid, now what do you do with the money? What do you do?
Is there always a strong pipeline? Today there is. Tomorrow there might not be. I'm not going to sit here and I don't know what the answer to that is. But as I said, mm-hmm. if you're going to go in the private world and your biggest risk is reinvestment, you're doing okay. Because at the end of the day, reinvestment risk means that we're sitting on too much cash, which means that our yields will drop. In that case, if you're unhappy with the yields and you're saying, well, my GIC is paying me 4, why should I be in a mm-hmm. mortgage fund paying 5? Well, guess what? We have a lot to give back to you. Cash.
Okay. Right.
And so I always tell people, whenever you get into Trez or anything else, you have to do your due diligence, right? You have to look at what is the premium. Today it makes a ton of sense, right? Because mm-hmm. you're earning 400 or 500 basis points over a 2-year government of Canada.
Right.
And so today taking those incremental risks makes sense. Mm-hmm. Let's say interest rates go up and say we don't go lockstep and GICs are paying 5% and we're still only paying 7%. It doesn't make sense to take that additional risk in this asset class for 200 basis points over something that's guaranteed.
Right. Yeah, people have to pay attention to what they're getting into and monitor it.
Yeah, and anything else, you have to look at your overall return and what something that, as you call the risk-free rate, and break mm-hmm. it down.
Yes.
And say, okay, why am I getting as high as I do? And what people in the short-term bridge financing space understand, and even the private equity world, it's all about value add stages, and that's why people are willing to pay more. Internal rates of return are higher. That's why in the private market, and the best part is you're not at the beck and call of the public market, so there's patience.
Yes.
Right? We're not, it's not the stocks going down or stocks going up and public calls and all of that stuff.
Mm-hmm. Now, who's an ideal investor?
Well, first of all, an ideal, the private stuff is only available to what you call accredited investors, right?
Okay.
And
what does that mean?
Different provinces have different rules. In Alberta, basically everyone's accredited because you make $70,000 or more, you're accredited, or $75,000.
Let's say here in Ontario.
And here in Ontario, it's an accredited investor is one that earns an individual $200,000 or more in income, as a family $300,000, or $1 million of liquid assets. So therefore, outside of your home.
Okay.
It cannot include your home. And by the way, people have gone into trouble with this before because if you include people's home in Ontario, everyone's accredited, right?
Right.
So So one is the accredited, but off that is someone. First of all, let me drop, because we distribute far more via third parties like advisors and institutions and stuff of that nature. I guess the quintessential question is what kind of advisor uses it, and that's someone who's looking to diversify a portfolio, who thinks outside of the box. It's very hard for a lot of advisors, and a lot of people have been so used to the direct public markets, to think about something like this. I always have the attitude, the banks can explain to you why you lost 30% of your money. They can't explain to you why your money can only be gone every 30 days, right? Because we have 30-day liquidity. You can't get your money. You can't get your money. If you wanted it tomorrow, you can't get it. It's on rolling 30 days. The bank people always have trouble understanding. They can explain 30% loss. They find it very hard to explain the liquidity, and liquidity is a big part of their business, right? Getting in, getting out, and all of those things. So the ideal advisor is one that creates a proper portfolio, properly diversified, and the ideal client is one that understands why it is we get the rates, understands that it's a longer term investment. Generally, we deal with more affluent individuals because of the accredited investor rule, and given the fact that I personally would never propose more than 10 to 15% of a client's portfolio. 15 is the max, and that's someone who knows real estate. But if you do the math, and if our average ticket size, that's probably about a couple $100,000 and 10%. So that's you're looking at clients, high-end clients that generally do it, and that's just because of a diversification perspective.
Okay, and that makes sense.
Yeah.
Now, what's the best way for people to reach you?
Well, via email is the best one, and I think you might be putting it up here, but you'll be happy to know it does not include my last name.
Good.
It's just Vikram, Vikramr, as in Rajagopalan, at trestcapital.com.
Okay. Well, thanks for dropping by.
Thank you, Pramod.
Thanks for joining us for Tea at Taxevity. The Taxevity Insurance Advisory helps you understand insurance and bridges gaps in your coverage. There's no premium for peace of mind. How healthy is your insurance?